Hey everyone, it's PJ Patterson here for Market Update. Today is Thursday, the 5th of August. Can't believe it's already August. We're well and truly more than halfway through the year, and staring down the back of the last quarter or so of the year. And a lot is changing out there, and I want to go through that today with you because we're still looking at quad three. So top three things in the notebook today. I'm going to talk a little bit about earnings because this is kind of an important pivot point around earnings and the earnings story with a lot of companies. Number two, just review the quads. You can see it on the screen right now. Review the quads in quad three, which is where we're heading. And then finally, just talk a little bit about the repositioning of the portfolio. You would undoubtedly be seeing trade reports and things coming through. For those of you that have jumped into Interactive Brokers login and had a look at positions, you can see some of the things that are in there. It might not mean a lot to you, but I'll just kind of broadly speaking give you a bit of a breakdown on where we are still sitting in that respect. But first, I want to talk about earnings. So as you can see here, we've had a monumental, and this is the S&P 500 earnings reports, 360 companies out of 500 thus far reported for this reporting period. And as you can see, just green lights everywhere in terms of sales growth, earnings growth. The reason energy is not measurable, probably because it's off the charts and just had a monumental amount of earnings growth. Now, this is great for certain sectors of the economy, and this is off the back of the fact that we've been in quad two, and the market was pricing in quad two. We've been having great positive earnings reports coming through. The S&P 500 continues to hit some new all-time highs, and as does the NASDAQ and a couple of other, the commodity index. But the point of all of this is to say that we have now very likely peaked in terms of earnings, broadly speaking. Now, we will not have peaked in earnings in terms of things like energy and probably some industrials, because those companies will have earning power because of the continued rise in commodities. So if you just think of the energy complex as the price of oil continues to rise, well, what's going to happen? Of course, all the oil companies are going to continue making profits because they just sell oil or pass on the price of oil to their end buyers. So things like energy will continue to do well, even to some degree, infotech, and then I'll talk about some other pivots in a moment. But one of the key things, again, to remember about earnings is we have just hit the top of the cycle, of this part of the cycle for earnings. So the comparisons are going to get tougher, again, only in certain aspects of the breakdown of the S&P 500 or the broader asset classes out there. And others will continue to accelerate because of the inflationary conditions that we continue to see in the market. So just quickly to refresh where we are in terms of the quad. So again, we are moving into, or have moved into, a quad three, and that's this area here, a quad three stagflationary environment. So growth has already begun to slow. We've seen inflation staying high, and it will continue to sort of trend either a little bit higher or possibly just on an even keel, but it isn't going to spike as inflation often does and come back down. This is going to be a bit more of a sticky type of inflation. And again, we're going to probably see that flowing through, particularly the energy complex, but you'll see it in some other places as well, in some materials, and probably in gold. And of course, the US dollar will start to fall a little bit as well as the growth story slows. That'll mean that the central bank's response is going to invariably have to be, pardon me, the cutting of interest rates. But nevertheless, if you just have a look at the quad three broad, this is a broad-based sort of how you position the sectors and the asset classes. As you can see here, the best sectors to be in quad three are utilities, technology, energy, consumer discretionary, just to name a few. Industrials are there as well. And effectively, and one thing I want to draw your attention to here is a style factor. And one of, well, a couple of these actually, secular growth and low beta and quality are three of effectively the style factors that we have currently built into the portfolio. Now, I'm going to go through just a little bit of the positioning in a moment, but I just wanted to remind you that this game that we play of investing is all about being dynamic in how we position our portfolios. So I just wanted to share with you real quick. I'm going to drag it into the screen. These are just some slides from one of my presentations. It's sort of my my keynote, if you will, presentation. And I talk in this presentation about risk profiling. And many of you have probably heard me talk about this, but I think it's worth refreshing because something that I heard on the macro show today, Keith McCullough and the guys at Hedgeye, he was talking about the fact that our portfolios have to constantly be dynamically changed. And the reason for that is because the markets change, the cycle of investing changes. So the current way of risk profiling by, let's call it old wall or the establishment, right, the industry, if you will, is it's outdated. It's very static. And I know that because I've been doing this for 20 odd years. And I also know it because the risk profile questionnaires that I have to get you to do, and I still am required to get you to do those, really only they give me, when you fill them out, they give me an answer that is putting you broadly into one of these four categories. You're a conservative, balanced, growth, or high growth investor. But the reality is that your goal really is to make as much money as possible through your investments with the lowest amount of risk. Now, hopefully you're shaking your head right now at home and saying, yes, that's exactly what I want to do, PJ. I mean, I don't know too many people that say, no, I want to have as much risk as possible and I don't necessarily want to make any money. That of course, is ludicrous. Every investor wants to make as much money as possible with the lowest amount of risk. Now, unfortunately, these risk profiles that you get pigeonholed in, if you say, if you end up as a conservative investor, well, the weightings of those things are going to have you slanted towards fixed income securities and very conservative sort of investments. They're going to have a much lower yield or much lower growth rate. And of course, then you're subject to things like inflation. However, I look at it in a much different way. And I'm just going to see if I can grab the slide. I think I've shown this before. But I call this an adaptive risk profile model. And it basically is that as we change, as we move through the sine curve of the business cycle, it just dictates that we have to change the makeup of the portfolio. So again, we've gone through the quad 2 where we were heavily into the value, the small cap stocks, the secular growers, the high beta stocks, things of that nature. We got rid of all the fixed income and gold and stuff like that performs really poorly in a quad 2 environment. And as now we are rolling over in terms of the earnings cycle and the growth cycle, it now means we have to move the portfolio into a slightly more conservative stance. It doesn't mean, though, that there isn't any part of the equity market that we can be invested in. And again, this is where, and I'm going to talk about it in just a moment, we want to own certain exposures or certain, they call them factor or style factors within the equity market, take advantage of that slowdown. And then at some point we will, if we go totally defensive, if we get into a quad 4 scenario, we're nowhere near being in that scenario at the moment. But if we do look like we're going to be heading into that, sort of scenario, it means we're going to have to go completely defensive. That's when you're fully into US Treasuries and Australian Treasuries and gold, and even for that matter, just cash, just being completely defensive. So I thought I'd refresh that for you because it's so important that you understand that this is how I'm managing your money. And over the long run, you're going to benefit from that. Anything can happen in the short term. I think many of you who comment to me or text me when the market's having a bit of an episode of volatility or something, and we see a big sell-off, you're very hypersensitive to that because you have an emotional response to that, which is, oh my God, the account's down. But the reality is those things are very short term, and they, you cannot simply cannot predict markets over the short term. But over a longer term, you can predict where markets are going to go because a lot of the data drives and determines where the market is going to go. Anyway, I thought I would just refresh that for you real quick today, just to give you that comfort that we are anticipating and positioning for the slowdown. And the problem, if I just go back to that slide, the problem that big investment houses have if they stick you into one of these portfolios is you got to stay, or you don't have to stay there. You would have to make the adjustment yourself to move out of these, but they're then pretty much hamstrung in the fact that they have to keep the money invested in that strategy, regardless of the fact that that strategy might not work in a particular part of the cycle. And you can see here, hopefully you can see it at home, but at the bottom here, I have sort of color coded and put the terminology in there as to the type of investor you need to be at that part of the cycle. So anyway, I call it adaptive or dynamic risk adjusting or risk ranging, risk adjusting your portfolio. So anyway, that is enough of that. Now let's just talk about positions for a moment. So at the moment, and I will do a position update this week for you. I've also got a macro update tomorrow. I was going to try and hold off and do this tomorrow, but I thought, nah, I'll go ahead and flick one out today for any of you who might be wondering what's going on, particularly at the moment with energy, because that's been a little bit of a laggard in the last month. But anyway, the portfolios right now, and this may not apply to everybody. So I've had some new clients come on board, and I'm trying to load up and transition your portfolios into the appropriate stuff at the right price. But in any case, right now we have 39 active positions inside, or you should have about 39 active positions inside of your account or your individual accounts. And of those, 17 are what I call macro positions. So they're macro ETFs. This would be like your XLE. It'd be, actually, I can drag this over into the screen here. Give me 2 seconds and I'll actually talk to it just very briefly. So as you can see on your screen here, I'll just blow that up. The macro positions would be things like quality, which again is a style factor. So that's your really big mega cap stocks that do well in a deflationary type environment. These are stocks like Facebook and Starbucks and Apple. But in any case, macro positions are ETFs that hold anywhere between 15 and 40 different stocks. So we get a lot of diversification across that particular asset class that we want to own. So there's 17 of those macro ETF positions. There are 2 positions right now in gold. So the commodity itself. There's 4 fixed income positions. So these are all ETFs, by the way. 4 fixed income positions. And I'm transitioning into the fixed income space now. So fixed income, one of the reasons you go into fixed income in quad 3 is because a lot of the equity market stops working and we start to see the fixed income trade coming back. So yields start to fall as bond prices rise. And of course, if we then transition into a quad 4 environment, again, we go completely defensive. But it will enable us to protect the capital that we've built up and earned in the last year. So that's, very important concept. And I'm sure you heard me talk about this before, is we want to preserve and protect the capital that we've just made, or the return that we've just generated. And this last year has been a very good return generating year. Finally, we have 16 individual stock positions. So these are things like I just mentioned: Apple, Facebook, Starbucks. I own a couple of real estate investments, PSA, Public Storage. That's a U.S. company. I forget what the A stands for. We've got where is it? A lot of this, sorry, it's right in front of me. A lot of the energy stocks we're still holding. Now, this week we've had option expiry in the energy complex, and oftentimes that creates some volatility in the energy space, and it's not any reason to panic or anything like that. Well and truly, as the dollar continues to fall, the price of oil will continue to rise. It's still in a bullish trend and a bullish trade. So I'm not concerned at all currently about the energy positions. And I fully expect that we'll be ringing the register on those. But again, as I often say, I reserve the right to change my mind based on and change the positioning of the portfolio based on what's going on in the market, what the data is telling us. And right now, the data is saying that oil is still in an uptrend and in a bull trend. And as the dollar, again, we often talk about, or have often talked about, the dollar. And if you get the dollar's direction right, you're going to get a lot of other things right. And currently the US dollar's direction is actually down. So that's going to bode well for many inflation hedges like energy. So anyway, 39 total positions. I've just broken those down. I'll go into each one. I'll do that on Friday and go into each one for you and give you a bit more sort of a rundown, I guess, on those. But there you go. That's where things are at right now. And I will say, one of the things I am really making an effort to do well is get the pivot right. Because if I get the pivot right, what it means is that I get out of stuff that has begun to stop working while preserving the gain that we have made, hopefully, over that period of time, and move into the anticipatory trades or positions for the next quad. So that's what pivoting is all about. And again, when we can see that pivot coming, or I can see that pivot coming because of the way the data is beginning to unfold and suggest exactly what's going to happen in the economy. So again, start with a macro, we drill down into the actual quad environment, and then into the individual sectors and style factors that we need to own in the portfolio. Anyway, that's probably all I have to say today. Hope you're all enjoying your lockdown. Not. I think this is a very tough time for us here in Australia, particularly in Sydney and in New South Wales with all this going on. I hope everyone's doing well. If you do have any concerns about anything, please pick up the phone, shoot me an email, shoot me a text. You should know how to book yourself into my calendar via the Calendly link that is in the boardroom in Facebook. If you are not a member of the boardroom, it might be because you don't have a Facebook account, but to become a member of the boardroom, you and I need to be friends in Facebook, and then I can invite you to be a member of the boardroom. And so that's initially where this content goes. It does then get emailed out to everybody. But if you want the first cut of it, you'll get a notification, of course, when I post something in the boardroom. But again, please, for anyone that might be experiencing any sort of financial stress or anything else, I'm here to help if you need it. Please just try to stay as focused as you can on your family, on your work, and even getting a bit of exercise. Go out, have a walk during the day, or whatever you need to do. I'm sure employers are being as accommodative and as reasonable as possible. At least I hope they are. And let's just hope that our government starts to be a bit more reasonable with all of this. So anyway, hope everyone is well. I'm obviously in the office working away. So again, if you need anything from me, please let me know. And I've got, and I will announce that I've got our new wealth portal up and running. Lady and I have been working on getting that set up, and I'm starting, again, I think I've mentioned this before, but I'm starting to roll that out slowly. I don't want to have a big flood of clients trying to get set up, because it'll then cause us to fall way behind. So we're rolling that out slowly but surely, and your name will likely be on that list to get that rolled out very soon. So I'll have more on that as it happens. And again, have a great weekend. I will do an update on Friday with the positions, and probably a little bit of commentary from the mid-quarter market update that I'm going to be getting from Hedgeye tomorrow. So have a good afternoon, and I'll talk to you soon.